Hi everyone, hope you're doing well. I am putting another video together because this question seems to be popping up quite a bit, so I figured I'd give a little bit of info on this. It's regarding high ratio mortgages. I do get clients that will ask, is it better to have 20% down or more or less than 20%? So I guess the first thing to understand is in Canada, any mortgage that is done where a lender, and it doesn't matter if it's a big bank, small bank, or credit union, any lender that lends on a property that has a loan to value, so a mortgage amount higher than 80% of the property value, is considered a high ratio CMHC default insured mortgage. Lots of different names for it, but basically, when your down payment is less than 20%, there is this insurance. You get the insurance through, think of it from the government. The most common name would be CMHC. There are a couple other institutions, Genworth and Canada Guarantee, that do this as well. But just make it simple. Think of it, you put the down payment less than 20%, you need to go to the government and ask for permission. So there are pros and cons to this. I'll go with the pros first. The benefit actually of having an insured mortgage. So less than 20% insured mortgage. Having an insured mortgage and getting the insurance through the CMHC or the government equates to a better interest rate. Why? Because you are paying the insurance to the government, and that insurance actually doesn't cover you. It covers it covers the bank on default in case you don't make the payments. So for the bank, it's actually a really good situation. You pay the insurance, government insures the mortgage, and if you don't pay, the bank just collects the balance owing from the government, and there's minimal risk. So you actually get a better rate. I have another video which breaks down the different types of rates. There are insured rates, uninsured rates, and insurable rates. Three different ways of identifying what type of mortgage rate you're going to get based on your down payment, total length of the amortization. Anyways, there's another video for this which goes into more detail. So that's the benefits of having less than 20% down is the better interest rate that you get. Now, there are downsides, obviously. First thing being that insurance premium that you have to pay to the government is quite pricey. It breaks down in different percentages depending on the amount of your down payment, whether it's 5%, 10%. And last, I guess, but not least, tougher guidelines as well. The amortization maximum is 25 years. There's different rules. So give me a call. I can go over in more detail, but yeah, I would say that's kind of the nuts and bolts behind having an insured mortgage versus an uninsurable mortgage and putting a down payment of less than 20% or 20% and more. All right, hope that helps and talk to you soon.